Welcome to this explainer. If you're a focused learner who really wants to understand the actual nuts and bolts of how our world operates, well, you are in the exact right place. Today, we are going to completely dismantle a fundamental assumption you probably have about the economy. We're looking at a totally mind-bending paradigm shift regarding how money is actually made. So let's just dive right into this, because what we're about to uncover is going to completely change the way you look at your bank account, your mortgage, and honestly, even your daily commute. I want you to really genuinely think about this for a second. Where does a bank loan actually come from? Like if you walk into a branch right now and they approve you for a $20,000 loan, where does that literal cash originate? For sure, most of us have this very specific, almost comforting image in our heads of how this works, right? We think of giant steel bank vaults, careful saving, and this really neat, orderly system of recycling money. But to understand reality, we kind of need to take a sledgehammer to that assumption. So to get to the truth, we actually have to travel back to the year 2014. An economics professor named Richard Werner spent months, literally months, convincing a small bank in Germany to let him observe something that nobody outside the banking system had ever witnessed before. He wanted to sit inside the bank while a real, actual loan was approved and processed. And eventually, the bank agreed. They opened their books, they opened up their systems, and they allowed him to see exactly where the loan money came from. And what he found brilliantly illustrates the reality of modern finance. What Professor Werner watched, step by step, made accounting way more exciting than it has any right to be. Because he watched the bankers create brand new money out of absolutely nowhere. There were no deposits used, no central bank reserves were magically moved around in the background, not a single savings account was touched. Money that simply did not exist one second existed the very next. He became the absolute first person in history to document this entire process from inside a real commercial bank. Now, look, I know exactly what you're thinking. Your brain is probably rejecting this explanation right now. Honestly, mine did too when I first learned it. It sounds like some crazy fringe internet theory, but it's not. Shortly after Werner's observation, the Bank of England effectively admitted the exact same thing in one of their own official publications. They confirmed it in black and white. So this isn't some conspiracy territory we're entering. This is just the mechanical, fully documented reality of the global financial system. Let's break down the myth versus the reality here. We've all grown up believing that banking involves complex vaults and serious folks in expensive suits carefully reallocating funds. The myth is that when a bank gives out a loan, they're basically saying, hey, sorry, Linda, we're just going to temporarily borrow your retirement pension so Jason over here can finance a jet ski and a midlife crisis. That is absolutely not what happens. The reality is almost insultingly simple. A banker opens a computer, types numbers into Jason's account, and in that exact moment, money that didn't exist a few seconds earlier suddenly exists and can be spent immediately. And hey, if you're still feeling a bit of disbelief, you are in really good company. Whenever researchers survey people and ask, hey, who creates the money in your country? Almost everyone says the government, the central bank, or the treasury. Almost nobody answers commercial banks. And yeah, sure, the government and the central bank do create some money. But private commercial banks? They create the overwhelming majority of all the money in existence today. Let's see how this all builds up by looking at the three actual types of money. First, you have central bank reserves. Normal folks like us never see this. Banks just use it to settle payments with each other. It's basically a VIP lounge that your debit card is definitely not invited to. Second, you have cash. You know, the physical notes and that $14 living permanently in your car's cup holder. This is created by the central bank, but it makes up a tiny, tiny percentage of all money. The third type, that massive slice of the pie, is digital commercial bank money. That's your salary, your mortgage, your savings. And here's the kicker. Banks aren't desperate for your deposits because your cash doesn't actually limit their ability to lend. So how do they actually pull this off? Well, the short answer is through something called double entry bookkeeping. I know, accounting sounds incredibly boring, but I promise you this simple definition is the literal secret engine running the entire financial system. Every single transaction gets recorded twice on a bank's balance sheet, once on the asset side and once on the liability side. Now, what's really interesting about this slide is seeing how this magic trick actually plays out in action. Let's say you borrow $20,000. The bank writes down on the asset side, this customer owes us $20,000 in future repayments. That belongs to the bank. Then on the liability side, they write, we owe this customer a new deposit of $20,000. That is the money now sitting right there in your account. One entry on the left, one on the right, both increase. No vault was opened, no physical cash moved. The mere act of creating those accounting entries literally typed the money right into existence. Now, you might be waiting for the catch. You're probably thinking, surely banks need to hold at least a 10% reserve of actual cash before making that loan, right? Well, you're about to be very disappointed. In reality, reserve requirements in many countries are extremely low or even zero, as in none, 0%. So the absolutely crucial point here is that the real question isn't whether banks have enough money to lend to you. The question is simply whether banks want to lend to you. Okay, let's assume you've accepted this strange new reality. The bank typed money into existence and you went out and spent it. You bought a car, renovated the kitchen, or maybe you purchased that wildly expensive espresso machine that now judges you every single morning from the kitchen counter. Either way, you've injected this brand new money into the real economy. But eventually, you have to pay that loan back. So what happens next? This is where things get genuinely fascinating. As our source material beautifully puts it, every loan is actually two things wearing a trench coat pretending to be one thing. Those two things are the principal and the interest. They are entirely separate components of your loan, and as you're going to see, they suffer very, very different fates as you make your monthly payments. Check out the life cycle of a loan. You borrow $20,000, and over the life of the loan, you might owe another $4,000 in interest. As you slowly repay the principal, that money doesn't just go into a bank vault to be saved, it literally disappears from the economy. It is deleted, removed, just gone. The exact same keyboard that created the money effectively destroys it. But importantly, not all of it disappears. The only thing left behind in the economy, sitting safely in the bank's profit accounts, is the interest you paid. The principal appeared, the principal disappeared, and the interest stayed behind. Now hold on, before you start thinking banks have infinite unchecked power to do whatever they want, we do need to be clear about something. Banks cannot just create unlimited amounts of money out of thin air on a whim. They are constrained by reality. They absolutely need borrowers who can actually repay the loans. They need enough capital on their books to satisfy strict banking regulators. And above all, they need a very strong belief that the bank is going to make a profit on the transaction. So yes, risk still matters. But within those constraints, banks get to make one incredibly important decision. Who gets the new money first? Put yourself in the bank manager's shoes for a second. Person A comes in and wants $80,000 to open a new restaurant. But we all know restaurants have an unfortunate habit of occasionally turning into empty buildings with faded motivational quotes still painted on the walls. It's highly risky. Then person B asks for $700,000 to buy a house. A house is a real, tangible asset the bank can legally seize and sell if the repayments ever stop. Ask yourself, which loan feels safer to the bank? Exactly. So naturally, the overwhelming majority of newly created bank money flows directly into mortgages and existing property. And once you see where the credit flows, the macroeconomy starts to make a whole lot more sense. Every single mortgage approval creates brand new purchasing power. It is new money chasing the exact same limited supply of houses. When that process repeats millions of times over decades, house prices don't just gently rise, they accelerate. The housing crisis is at its absolute core, a money creation phenomenon. I want to slow down for a second here and just zoom out from the accounting ledgers and the macroeconomics. Because beneath all the financial jargon, there is a profound, almost uncomfortable, philosophical reality at play here. As our source material states so perfectly, money is your labor frozen in digital form. Just let that sink in for a moment. Hours of your life literally converted into numbers on a screen. We are talking about your actual time. Every early morning alarm in the dark, every long commute sitting in brutal traffic, every grueling overtime shift you took, every single soul-crushing Monday meeting that absolutely could have been an email, you are constantly trading finite, completely unrecoverable pieces of your actual life to accumulate this digitally created commodity. You trade your real life for numbers typed into a screen by a commercial bank. Which brings us to the ultimate takeaway of this explainer. Understanding the mechanics of money creation isn't just about finance or being a trivia master about double-entry bookkeeping at dinner parties. It is about deeply understanding the exchange rate between your life and the world around you. The financial system directly affects the house you can afford, the business you might want to start, the risks you can safely take, and ultimately, the level of freedom you have. Now, understanding the system doesn't magically fix the housing market, and it certainly won't make you a billionaire overnight. But it does do something incredibly important. It means you stop playing the game without knowing the rules. Because if you don't understand credit, you don't really understand money. And if you don't understand money, well, who is writing the rules for your life? Think about that for a while, and never, ever stop questioning the systems that govern our world.